And we're live, everybody. Welcome back to Strongman Personal Finance. I'm your host, Christopher Bell. All I ask is that you hit the like button and that you subscribe to my channel. Now, who am I? I am a boglehead investor. That means that I don't time the market like a clown. I invest in broadly diversified total world stock market index funds, and I hold those funds forever because I am a long-term investor. So if you've stumbled on my channel and you're trying to find the next hot stock, that's going to 20,000x in 5 seconds, or you want to learn about put options or calls and GameStop, you're not going to learn any of that here. I advocate real wealth building, not BS wealth building. And that makes me talk about things like Vanguard. Now, Vanguard is a broker, and it is a massive broker. It has trillions of dollars of management. And it was a pioneer in index investing, which I'm a huge fan of. Now, if you don't know what index investing is, there are these things called indices, which are baskets of stocks. There's an index for everything. You can create your own index if you want to. There's an index for utilities, there's an index for real estate, and there's also an index that tracks the entire world. Now, I forget the name of it. I know I'm guilty. I think it's the Morgan Stanley All World Stock Index or something like that. That's the index that I invest in. But Vanguard was the one that really pioneered it with this guy named Jack Bogle. He's my personal hero. He's dead, which is sad, but he's my personal hero. He was the one that pioneered index funds, and he stuck it to the man. He stuck it to the financial advisors and the scummy Wall Street loser scumbags that have been screwing people over with high turnover rates in their portfolios and high fees. Now, Jack Bogle had this genius idea that instead of entrusting your money to some clown manager that didn't know what they were doing and paying massive taxes and high fees, you could instead own the entire market in one fell swoop, and you hold it, and it has very low turnover and very low fees. Now, people think that holding the entire market is lame and boring, and they want to beat the market. But what they don't understand is that you can't beat the market when you factor in transaction costs, taxes, and fees. That is the fundamental reason why I'm a boglehead investor. Somebody may be able to beat the market. Some people have historically, but that's very, very rare. And it's hard for you to identify a fund manager that's actually going to beat the market. And most likely what's going to happen is if you invest in an actively managed mutual fund, you're probably just going to pay a lot of taxes. You're probably going to pay a 1% fee every year. And you might maybe equal the market or probably do worse than it, especially after factoring in the effects of taxation. So I'm a huge fan of Vanguard. They were the pioneers, but I also invest in Fidelity. And pretty much every other broker now offers index funds, or you can buy index ETFs because they become so popular because a lot of people have realized that instead of buying individual stonks like the morons on Wall Street bets, instead of that, you can just buy the whole market, own it at low cost, and hold it forever because you're a long-term investor. Now, right now, we're on Vanguard's website, and I had the inspiration today to just kind of go through some of their mutual funds. Because when you go to a broker, you might be totally confused about what to buy because there's so much crap offered. And I totally understand. I had the same problem for a long, long time. And what finally dawned on me is that instead of trying to pick and choose 1,000 different mutual funds, instead of doing that, why not just pick one or maybe two and keep your portfolio as simple as possible? Because the less crap you have in your portfolio, the easier it is to track your investments and the less overlap you have. So we're going to go through the Vanguard mutual funds. I'm going to kind of talk about each asset class, and then I'm going to show you what I invest in. Doesn't mean you have to, but I'm going to show you what I invest in to keep it really simple because I think Vanguard has 100 mutual funds. Now, let's go ahead and dive in. Let me see if there's any questions. No questions. All right, so let's go ahead and dive into the Vanguard funds. So, browse Vanguard's complete fund lineup. And I highly recommend Vanguard. Great company. Now, we're looking at Vanguard's mutual funds. So, as you can see, they offer mutual funds and they offer exchange-traded funds. Now, these are kind of similar and they're kind of not. Mutual funds don't actively trade throughout the day. So if you want to buy a share of a mutual fund, you have to place an order. And then after the market closes, then they'll process your order and you'll own a part of that mutual fund and you'll own part of everything that's inside of that mutual fund. And an ETF or an exchange traded fund actively trades throughout the day. So for example, you could have a mutual fund that invests in the S&P 500 and you could have an ETF that invests in the S&P 500. The main difference is that ETF, you can only buy it during the trading day. So you have to get up and at 9:30 or whatever when the stock market opens, and you have to go and buy shares of the ETF if you want to buy it during the day. Whereas in the mutual fund, you can just set up an automatic investment, and at the end of the trading day, the money automatically comes out of your account and it gets invested. It's a lot easier than ETFs. ETFs are good because they're liquid and they're slightly more tax efficient than mutual funds. But if you're just an automatic investor, you don't really have to worry about ETFs. You can just set up an auto draft, set up your portfolio, and invest in mutual funds. I personally have ETFs in Fidelity because I just prefer them. I like the liquidity and to be able to watch them fluctuate all day. But if you're a long-term investor, it really doesn't matter. So let's go ahead and check out Vanguard's mutual funds. So looking here. So they organize it by asset class. So you can search it by asset class, or there's tons of different asset classes, or you can search for it by fund name. Now, when you're building your portfolio, you want to sort your portfolio based on asset class. You want, let's say you want some international bond or international bonds. Well, that's a certain asset class. That's going to fall under international bonds. Let's say you want US stock. That's another asset class. And those can be further parsed down into small cap stocks. Those are small companies, mid cap stocks, large cap stocks, or you can own them all like I do. Now, when you're looking at each fund, there's a couple things you're going to see when you're looking at it. So starting from the top, you're going to see the name of the fund. For example, let's look at this Cash Reserves Federal Money Market Fund. This is where you'd park your money if you just wanted to hold on to it and wait for a market crash or something. So the name of the mutual fund is the Cash Reserves Federal Money Market Mutual Fund. The ticker symbol, which is just basically the abbreviated name of the fund, is VMMXX. That's the name of the fund. That's the ticker symbol. Now, it has the asset class. This is a money market fund. This is basically where you park your money for short-term liquidity. You're not going to long-term invest in a money market fund because they don't pay crap, okay? They're very safe, and the safer your money is, the less expected return you're going to have. So, like I said, you park your money here for short-term. Oh, I deposited some cash, and I want to just keep it there for a little bit before I buy something. Now, the next thing is the expense ratio. This is very important. This fee, which if you look at this one, if you look at this mutual fund, it's 0.16% per year. So out of your entire invested balance, you're going to pay 0.16% per year. So if I pull up my calculator, for example, let's say you have $100,000 sitting in this VMMX Cash Reserves Federal Money Market Mutual Fund. Well, if you're paying a 0.61% expense ratio per year, you're paying $160 a year in fees, which is not a lot of money. It's pretty high for a freaking money market, especially when you can put in a savings account. But you're only paying $160 a year for putting $100,000 in here. So that's the expense ratio. Now, the price is the price per share of the mutual fund. When you invest your money in the mutual fund, you're buying ownership or shares of that fund. Now, it doesn't matter what the share price is. It really doesn't. Because when you invest in a mutual fund, you can buy partial shares. You don't have to buy one whole share and then one whole other share. You do have to do that sometimes for ETFs, unless they have fractional shares. But let's say you wanted to put $15 into here. Or sorry, let's say $15.50. Well, if one share is $1, you're going to get 15.5 shares. So it's actually nice. Whereas if you don't have whole dollars, you can still buy fractional shares of this mutual fund. But the price per share is $1, and that should stay stable. Now they have the change here. That's like the day-to-day change. Who cares about day-to-day fluctuations? But that's what you would see here. Now, money markets are very safe, stable. They're not going to fluctuate rapidly, which is why people store their money there for the short term while they wait for market opportunities. The next thing is the SEC yield. Now, it's a little complex formula, but basically this number, this 0.01%, tells you how much money and interest you can roughly expect for the year. Now, a key thing I want you to know, your SEC yield on this money market fund is 0.01%. Look at your expense ratio. The expense ratio is higher than the SEC yield. So by parking your money in here, you're losing money, number one, to inflation, money printing, liberal programs, whatever. And number two, you're paying more in expenses than it's generating in income. And on top of that, you're going to get taxed on the income. So this 0.01% is not going to be a lot of money. For example, let's say you had $100,000 in here and you make 0.01% per year. Well, let's see how much amazing cheddar you're going to get. $10. So you're going to get $10 in interest, which is then going to be taxed. Let's say it's taxed at 22%. You're going to get $7.80, and you're going to pay an expense ratio of 0.16 or $160. You're going to lose almost $150 just by parking your money in here. So a money market fund is not for long-term investing. I'll say that 1,000 times. So you go over and you can actually look at the historical performance of this fund. So why can't I scroll over? This is annoying. Whatever. I have to zoom out a little bit. So the yield for year to date, as of today, from the beginning of the year, is 0%. So obviously this isn't making crap. Now, they have average annual returns going back 1 year, 5 years, and 10 years. So for example, if you look at the 5-year average return, on average, if you invested money in this fund 5 years ago, your money would have compounded at a rate of 1.22% per year. Now, that doesn't mean you get 1.22% per year. 1 year you might get more, 1 year you might get less. But on average, when it's averaged out over 5 years, you get 1.22% compounded per year. So they have it for 1 year, they have it for 5 years, and they have it for 10 years, and since inception. Now, since inception, it's a lot higher, 4.77. That's because interest rates used to be a lot higher. So that's why when you see like money markets, don't expect to get 4.77 because it's been that since inception. We're in a very low interest rate environment. So in general, money markets, you just want to park your money there. Let's say you're not sure what to buy yet because you don't listen to me and when I tell you to buy VT or VT Wax, and you just want to park your money in there and let it sit. It's going to be sitting in a money market fund until you decide to pull the trigger. Now, the next thing is tax-exempt municipal money market funds. So these are basically like short-term slush funds for different states. Now, they're slightly higher risk than, let's say, federal money market funds, but they're not really that much higher risk because if you think about it, a state is more likely to default on its obligations than the federal government. But how likely is that really for some states? I mean, some states maybe, but in general, a large state like California, New York, you're probably going to be fine. I would personally put my money into a federal money market if I was going to put money in a money market. But there are state money markets available. And the key advantage is that they're tax exempt. So the federal government actually doesn't tax state and municipal income on bonds. And that's to kind of like subsidize them a little bit because they're so nice. So let's say you put your money in this California municipal money market. You're still paying the same expense ratio as this one up here, 0.16. And you're still going to get the same return, but you're not going to pay federal income taxes. So you're going to have about $2 more a year. And there's, I guess, slightly more risk for being for a California municipal money market fund, but whatever. So once again, if you want to park your money here, I would park it in federal. I don't know why you'd want to put it in tax exempt, especially with rates so low. It doesn't even freaking matter. But that's what you would do. You would park your money in a taxable money market or a tax exempt before you bought something. Next, we move on to U.S. bonds. These are debt obligations. Now you have government bonds. The government needs to borrow money. It may be short-term debt. It may be intermediate-term debt. It may be long-term debt. States borrow money. Corporations borrow money. A lot of organizations borrow money. So when you're looking at U.S. bond funds, you're going to find a lot of government debt because there's a lot of government debt out there. And you're going to find a lot of corporate debt because corporations need to borrow money. So, for example, you're looking here at Ginnie Mae's. Obviously, we have the ticker symbol. This is an intermediate term bond fund. So when you think about bonds, the longer the bond is to maturity, the more sensitive it is to interest rate fluctuations. So if you're looking, let's find a long-term bond. For example, here, this long-term bond index Admiral Fund, VBLACks. VBLAC, yeah. This is a long-term investment bond fund. Expense ratio is low. Now, let's say you want high yield because you hate your savings account. It's so annoying. And you look over at the SEC yield and you're like, wow, 2.87% per year. That's a lot higher than a money market, right? Well, here's the thing. It's a long-term bond fund. So if there's a small change in interest rates, the value of this fund could fluctuate massively. Now, we can actually dig into it. Maybe I'll do that later, but just be very careful. The longer the duration, the longer the bond is, the more sensitive it is. So it's not necessarily a good idea to park short-term money into a long-term government bond index fund, because if interest rates suddenly spike up, the value of your fund can go down very quickly and you're going to lose a lot of freaking money. So this isn't necessarily for your emergency savings, all right? So these are all different kinds of bond. You have long-term treasuries, long-term government bonds, mortgage-backed securities. We all know about those from the financial crisis. Short-term bond index. Now, if you want to have money stored away for the short term, it's better to do as short as possible because it's less sensitive to interest rate fluctuations. Now, if you're worried about inflation, they actually offer inflation-protected securities, which they adjust the principal of the bond based on the inflation rate. So it gives you a little inflation protection, but you're going to get a lot lower, or you're going to get a lower yield than a bond that doesn't have an inflation-protected component because you're taking on less risk. You're protected from inflation. So there's actually a little bit of inflation risk premium built into longer bonds that don't have a inflation component. So like looking at the short-term inflation securities index has a negative yield, but that's because it factors in inflation. So you're not necessarily going to be losing money on it, but your yield is not going to be high, or it's going to be negative because it's factoring in inflation. So that's it. Short-term treasuries, blah, 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 blah. So now we have investment grade bonds. So this is probably diving into more of corporate debt. Now, corporations that have high credit ratings that are very likely to pay back their debt are classified as investment grade. So if you want to invest in corporate debt and you're looking, for a decent amount of safety, you want to look at investment grade. So here we have the core bond, blah, 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 intermediate term corporate bonds. Like I said, that's, midterm corporate bonds. We have long-term corporate bonds, et cetera, et cetera. Now, the same thing applies to corporate bonds as it does to government bonds. The longer the bond, the longer the term of the bond, the more sensitive it is to interest rate risk. And since we're in a historically low interest rate environment, and there's always the risk of inflation with money printing, you're actually taking on a lot of risk if you want to park a lot of your money into a long-term corporate bond index, even if it's paying 3.3%, because that fund could go down very quickly if interest rates rise. So be very careful. So personally, if I wanted to keep a little bit of bonds, I'd probably do like ultra short-term bonds, for the short term, or, money market, something like that. Something that's not going to fluctuate rapidly. Let's see if you have any questions. What's up, man? We're going through Vanguard mutual funds. All right, so continuing. Below investment grade. So we're still on bonds. Now, below investment grade are bonds that they're sometimes called junk bonds, but they're basically bonds that are higher risk. They're more likely to default than investment grade corporate bonds. So when you're looking at below investment grade, this is like high risk bonds, basically. So they're going to pay a higher interest rate, but don't be sucked into it because, if the economy crashes, these are pretty correlated with stocks. So I personally don't invest in high yield corporate bonds or even corporate bonds in general because they're correlated with the stock market. So you might as well just be in the stocks. So next, we move on to tax exempt. So like I said, state, local governments, their bonds are not taxed at the federal level. So they're actually subsidized. So if you're like a very high net worth person and you're in the top tax bracket, you might want to look into putting your money into municipal bonds. But if you're average Joe like me or you, I mean, it doesn't really matter. I mean, there's nothing wrong with putting your money into municipal bonds, but you kind of have to compare. Am I making more money on corporate bonds or government bonds that are not tax exempt? Or am I going to make more money investing in tax exempt state or local bonds? So that's that. So going in here, we look, okay, interest rates, same thing. The longer the bond, the more sensitive they are to interest rate risk. Next, we have balanced funds. I actually like these. These are my babies. Now, we've only talked about bonds so far, which, if you don't know what a bond is, it's just a debt instrument. Somebody needs money, they borrow it, they pay you interest, and they pay you back at the end as long as they don't default. Now, a balanced fund is going to incorporate bonds and stocks. They're going to have both. And the reason they do that is because bonds, especially treasury bonds, they have a low to inverse correlation with stocks. So if stocks go up, usually bonds stay stable or go down. But it's the exact opposite. When stocks go down, bonds tend to go up because people flee to safety. So by having both, you're kind of smoothing out volatility. When one goes up, one goes down, and vice versa. And when one's doing well, you can sell it and then buy the one that's down. So you're kind of like rebalancing and selling at a high and buying at a low. So that's what a balanced fund is. So they have these like target retirement funds, which I actually encourage people to invest in once you do your due diligence, okay? But a target retirement fund basically changes the amount of stocks and bonds you have throughout your life. So for example, a target retirement 2015 fund, this is for somebody that's already retired because it's 2021. So this is going to have a lot of bonds. Whereas as you go to higher dates, 2025, 2030, 2035, you're going to have more and more stocks. So the younger you are, the more stocks. And then over time, it transitions you automatically to bonds. Now, in my Vanguard account, and I'm not saying you should invest in this, I have a target retirement 2060 fund. And that's literally all I freaking have. I have about 90% stocks and 10% bonds. Now, there's some clowns out there. They're like, oh, you know, 100% stocks. But I don't care. I mean, I've had pretty good returns. And over time, my fund is going to rebalance to bonds. Now, the beauty of Vanguard target retirement funds is that they're basically invested in every stock in the world, or they're designed to replicate the returns of every stock in the world. And they're basically invested in almost every investable bond in the world. So by buying a target retirement fund, you're buying basically all US stocks, you're buying all international stocks, and you're buying all international and domestic bonds. So you are extremely highly diversified. You don't have to think. You own the entire world, and it reallocates for you. It's pretty freaking cool. Now, people always complain about target retirement funds because they don't like how they transition or whatever. But if you're just average Joe, you don't know what you're doing. I mean, just be perfectly honest. Just put your freaking money in a target retirement fund or a total world stock market index in a Roth IRA, and you'll be fine, okay? The big thing to watch out for is your expense ratio. You don't want to pay a lot of money in expenses, which this is 0.15% per year. So if I had like, 75,000 in there and I paid 0.0015, I pay $112 a year in fees. Wow. Yeah, it's going to kill me. So that's that. And then we have target risk. So these are basically kind of like balanced funds. They're kind of like target retirement funds, but they have a target allocation. So instead of transitioning from more stocks to more bonds, they might just have 40% bonds and 60% stocks, and that's where they stay at. So if you're interested in like a balanced portfolio and you don't want it to change over time, like a target retirement fund, maybe check out a target risk fund. So you have like life strategy, conservative growth. That means they probably have more bonds. And then you have life strategy growth. That probably means they have more stocks, but you do have to look at each one and see what fits your needs. Okay. So now we go into more traditional, which I guess it's just like a mishmash. I don't really know what to call this, but it's still in the balanced asset class. So you're going to have different fund managers with a certain amount of stocks and a certain amount of bonds. But I don't think you necessarily need to go with these traditional funds. I mean, some of them are actively managed, which means you're going to pay slightly higher fees, even at Vanguard. And there's always a risk that the manager is a complete clown and then screws you over. So you don't want to invest in these traditional funds. Now, if you really do the research and you like it, that's your prerogative. but I prefer to hold indexes and manage my own money. And I don't want to pay a higher expense ratio. Like look at the Star Fund, 0.31% expense ratio. That's, I mean, for Vanguard, that's kind of high, but in general, that's pretty low. All right, then we have global. This is another global balance fund. So this probably has a lot of international stock exposure. Cool. All right, now we go on to U.S. stock funds. So this is where you're going to find a lot of your indexes. You're going to find the S&P 500. You're going to find the total U.S. stock market index mutual fund. You're going to find small caps, mid caps, large caps, all different types. So looking at here, you have the S&P 500. That's the largest 500 companies in the U.S. You have diversified equity. I don't know what that means. I mean, I guess it almost looks like it's actively managed. So I compare the expense ratio to the S&P 500, 0.04 versus this diversified equity, 0.35%. You're paying a lot more for that. And I don't even know what they're doing in there. So you have things like dividend appreciation, tax inefficient, dividend growth, tax inefficient, equity income, that sounds like dividends to me, tax inefficient, growth and income, maybe more tax efficient, but still tax inefficient. And there's all this crap, there's so many options. It's like, what do I invest in, And it's hard because if you bought like 6 of these, you're like, oh, that one looks good. That one looks good. That one looks good. You might have a bunch of overlap and not even know it. That's why it's better to just put your money into one fund or maybe 2 or maybe 3 if you really know what you're doing. All right, next, high dividend yield, tax inefficient. When you see dividends and you're not investing in a tax advantage account, that's a bad thing. You don't want a lot of dividends unnecessarily because you're being focused on a certain section of the market, generally value stocks, which you should have exposure to the entire market, number one. And number two, the more dividends you get, the more taxes you pay and the lower your total returns because you're paying taxes to the government. So dividends aren't these magical things that everybody seems to talk about, like all my favorite YouTubers. All right, so with tax managed capital appreciation, there's ways they can manage taxes like, tax loss harvesting, but we don't need to get into that right now. So there's all these different funds. Look at all this crap. Do you know which one to choose? I don't. So this seems like large companies, what we just went over, this large companies. Now we're looking at mid caps. So these are companies that I believe are between like 2 billion and 10 billion in market cap. That's the total value of the company. So these are companies that, are kind of proven. They've been around for a little bit, but they're not these massive American companies. So that's what a mid cap is. So, I mean, there's nothing wrong with mid caps. I mean, sometimes they've done very well. Sometimes they haven't, but they're a narrow slice of the market. The majority of the U.S. stock market is large cap. It's like 80%, whereas mid caps, very small slice of the market. So like I said, you have mid cap growth, mid cap value, so much crap. What do you choose? Maybe just a total world stock market index fund. Then we go into the small caps. All right. We have the Explorer. These are small companies. These are companies that they're relatively small. So, maybe they're 1 billion market cap, 1.5 billion, something like that. But these are small companies that they're going to be more volatile, but you could potentially get higher returns. But they're a very small slice of the U.S. stock market. So looking at this one, like the Explorer, just looking at the expense ratio, 0.41, that tells me it's actively managed, even for Vanguard. Same thing, Explorer value, 0.64, looks actively managed to me. So I would stay away from that. Small cap growth, index, okay, much lower expense ratio, whatever. But it's still a lot of crap. We've already looked at 20 or 50 different funds. Look at all this. Like, which one do you choose? I don't know. Maybe just keep it simple. All right, then we have international bonds. Cool. Global credit bond, whatever. You don't need international bonds, but whatever. If you buy the target retirement fund, you're not going to die. Emerging markets bond. I wouldn't touch that crap. International stock. I like international stock, and it should be in your portfolio. But the question is, what do you buy? Because you look here and you have global funds. Now, there's one fund in here that I've recommended a lot after you've done your own assessment and, decided it for yourself. But I like this one, this Total World Stock Market Index Fund, VTWAX. Now, the reason I like it, number one, very low expense ratio, 0.1. Number two, all this crap that we've looked at, all this stuff that I'm scrolling through, these are all different slices of the U.S. and international markets, blah, 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 blah. VTWAX has everything in it. So if you put $1 into VTWAX, if you can do that, I think there's like a minimum. If you put $1 into VTWAX, you're exposed to every stock in the world. All the US stocks, all the international stocks, all that crap that we just looked at. Why bother trying to like, slice and dice and build a complex portfolio when you can just put all your money into VTWAX and you own every company in the world and you're not chasing performance or market timing and you only pay 0.1% per year. That's what I like. You don't have to do that, but whatever. So I really like that one, but that's up to you. So there's more international, blah, 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 blah. Look at all this crap. Emerging markets, like all this stuff is in VTWAX. You can just buy VTWAX, have one thing in your portfolio, and that's all you need. All right, then we have sector and specialty funds. Now, I don't recommend these in general. They're highly concentrated in one sector. And you don't want to be so undiversified that you're only exposed to one sector of the economy. Even if it's technology or energy or healthcare, anything that's exciting to you, you don't want the majority of your portfolio in one sector of the market, because even though you might think healthcare is going to go to the moon, if you're a Robinhooder, I mean, maybe we go socialize medicine and you lose all your freaking money. I don't know. So be very careful with sector funds. Doesn't mean you can't own them. Like, I actually have a little bit of real estate in my portfolio. Doesn't mean you have to. But in general, I don't think you should. So overall, the key lesson in all this is looking at all these freaking funds. There's so much to choose from. But instead of keeping it so complex, just buy one fund. You could buy a target retirement fund, which I'll find that in a second. You could buy a target retirement fund and you own every stock in the world, or you're exposed to it, and then you have some bond exposure and it transitions you over time. Or if you just want to go 100% stocks, just buy every stock in the world with VTWAX. And that's all you got to do. You're done. One fund, done. Go to the beach. Go hang out with your kids. Go hang out with your wife or whatever. That's all you got to do. So that's that. Let's see if I have any questions. Exactly. That's why, like, I used to try to pick all these different funds and yeah. And then eventually I was like, screw this. I'm just going to freaking buy one fund. I don't have to manage anything. I don't have to worry about it. And boom, my money goes up and I don't have to worry about timing the market or anything. So that's that. So any questions, anybody? I might sign off. Maybe I'll do one more video. I don't know. It's hot in here. All right. No questions. Well, hope you enjoyed the video. Don't forget to like. Please subscribe if you haven't already. Tell your friends about me. I'm the man. What is this? I have the odd index. Is that Australia? I bought a house. We got Juan in the house. Yeah, no problem, guys. Oh, now everybody starts watching. Okay. Well, if you haven't already, please subscribe to my channel. Like the video. I may make one more tonight. I don't have much going on because I'm a loser and it's Friday night. I have nothing to do. But I'll see you guys in a little bit. Thanks for watching.